Swayam Prabha. Digital India. Educated India.
Hello everyone. Today we are talking about real estate investment strategies in this lecture. This is part of the course Real Estate Finance and Investment Strategies. So, the learning objectives, by the end of this lecture, you will be able to evaluate the three primary real estate investment strategies in Indian context, analyze the financial metrics specific to each investment approach, compare these three: buy and hold, fix and flip, and B are four strategies. Apply decision frameworks to select appropriate strategies. Calculate returns, cash flows, and key performance indicators. Assess market specific considerations across Indian cities. So first, the landscape of Indian real estate investment. So real estate contributes 13% to India's GDP, projected by this year, and then investment inflows are also rising up. Urban population is also projected to reach 40% by 2030. So there are these, size is significant, and the movement from rural to urban is also something we have to acknowledge. And all of this will definitely continuously impacting the real estate market of India. Briefly, we have discussed this, and again, we will just touch upon this, that the characteristics of a real estate market is that it is heterogeneous. No two real estate properties are alike. There is some or other reason to vary them. So there is it is a heterogeneous market. Then there is basically a pre-RERA period and post-RERA period. And since 2017, coming of RERA has brought lot of transparency, and regulation has safeguarded the investors. Then capital intensive nature is there of this particular asset class. Unlike share market where you can buy a single share, their investment in real estate is significant. And the cultural preference for property ownership is there in India, because post liberalization there was rapid gains which many made in urban and adjacent areas. And then liquidity challenges, which is there compared to other asset classes, that it is not easier to sell your properties as easy, at least not as easy as share market. Then there are certain investment drivers which we need to understand, that there is a rapid urbanization which is taking place in India, and we have seen that because of this upward movement of urban population, the urbanization requirements are also there. So it will need infrastructure development also. And there is a growing institutional investor participation, which is leading to systemization of the real estate in India. And then technology sector expansion in key cities is also there. New technology is coming up, and we have prop tech which is there, we have AI, we have blockchain. All this is expanding and improving the real estate in major cities of India. And also we have seen that the government initiative like housing for all, and in the ambit of that there are many policies which are impacting the real estate market of India. Then investment strategy selection framework. So basically it will depend on the capital availability, basically that how we can talk about. Then we have to talk about the risk tolerance, the kind of risk a person can take. So market volatility that will dictate, and then time horizon for which person is investing, then active involvement, how much actively they can get involved in a property. So somebody has to be continuously involved if they are looking for a specific property investment, and sometimes you will see that you will not have to be that involved. But generally, when we are talking about direct property investment, active involvement is there. Then skill and experience, how much skill, the knowledge level of a person has regarding the real estate, so that can impact. And the experience of understanding the real estate market, specifically, generally it's the local market where somebody is actually living, residing. They are much aware of that, and how much experience of that area is there for them. And then income stability is also one important factor. So because sometimes you will see that there can be negative cash flows also. So in those moments, income stability has to be there, so that you don't make rash decisions of selling early. So these type of factors are definitely very critical for the strategy decisions. And the market factors are also there. So property prices and affordability in target markets, that is something which is important, because sometimes property prices gets too high in certain areas. For example, in Mumbai, even a small flat quotes at a very high price, and investment in such scenarios becomes very difficult in real estate. Then we also have to look at the rental yields, whether they are impressive or not. So we have seen that when it comes to residential real estate, rental yields are not high, and as such there is investment for not for rental yield, but for price appreciation, that we see a lot in residential real estate in India. And also we know that the demand fundamentals are not fixed, they are continuously changing, because the real estate is not just linked to the local factors, but it also is impacted by the macro factors. So demand is also there, something which is under the market factors. Then we have appreciation potential, for which mostly the residential real estate is purchased, and infrastructure development. Many times we have seen that there can be projects, infrastructure projects, which can harm or which can benefit a particular real estate project. So that is why we have to look at that particular factor also. And apart from this, the regulatory environment and compliance requirements like RERA, and other local or central real estate rules, maybe the kind of zone in which your property is. So all this is impacting the investor profile, the overall critical factor for strategy decision regarding the investment of a particular property or person. Then we go to buy and hold strategy. So we have long-term wealth building through rental property. This is the core philosophy. Time in the market beats timing in the beats the timing the market. So longer you stay, better it will be. So maintaining a long-term perspective with holding period of 7+ years, and this allows you to ride out market cycles and benefit from long-term appreciation trends. The strategy emphasizes income generation through consistent rental cash flows, providing steady returns and potential inflation protection, wealth preservation and inflation hedging. They are important benefits. Then real estate historically outpaces inflation over long periods, protecting purchasing power. Leverage utilization amplifies returns by allowing you to control properties worth several times your initial investment. Then we move to professional management. Becomes important as you scale, allowing you to build large portfolios without proportional increase in time commitment. So that is something which professional management can provide you. Then we have investment process, so which follows 5 key steps. Property selection based on strong rental demand and growth potential. Look for location with maybe employment growth, infrastructure development, and demographic trends supporting rental demand. Second will be acquisition financing with optimal loan to value ratios. In Indian market, investment property loan typically offers 65 to 75% LTV with the rate 1 to 2% higher than owner occupied properties. So that is one area. Then tenant management and lease optimization. So this includes screening tenants, setting appropriate rents, and maintaining positive landlord-tenant relationship. And then we have property maintenance and value preservation. So regular maintenance prevents small issues from becoming expensive problems and maintain rental competitiveness. And finally, we have portfolio scaling through reinvestment strategies. As properties appreciate and loan balance decrease, you can extract equity to acquire additional properties. Then we move to key performance indicators. So understanding the buy and we have understanding this buy and hold financial metrics. We have rental yield calculations comes in two forms. One is gross rental yield equals annual rental income divided by property value times 100. This gives you the basic return without considering expenses. We have net rental yield is more accurate. We have annual rental income minus annual expenses and divide by property value times 100. So this gives you the basic return without considering the expenses, with considering the expenses. So annual expenses would include property management, maintenance, it will include insurance, it will include property taxes and vacancy allowances. So basically that will be your net rental yield. Then we have cash on cash returns, which measures your actual cash return. So that will be annual net cash flow divided by total cash invested times 100. So this will be particularly important when using leverage, as it shows return on your actual money invested rather than the property's total value. Then we have cap rate analysis, which helps to compare investment opportunities. So capitalization rate equals net operating income divided by property value times 100. So this matrix allows comparison across different properties and markets. Now let's look at the market yield in India, which is prevailing right now. So we have residential properties, which are typically generating 2 to 4% net yield, which is low compared to mortgage rates of 8 to 9%. And this often results in negative cash flow requiring external income support. Then commercial properties, often better yield at 7 to 10% net, making them more cash flow positive, but requiring large initial investment and different management approaches. Then we have retail properties that generate around 6 to 9% yield, net yield, but carry higher tenant turnover and market risk. And then we have warehousing, which is offering attractive 8 to 10% net yields, benefiting from e-commerce growth, but requires specialized knowledge and management. Then we go to Bangalore IT corridor investment case. So this is a example to understand buy and hold dynamics in practice. This case study uses basically looks at actual market data from Bangalore electronic city area. So our property details include a 2 BHK apartment of 1200 square feet in electronic city phase 1. The purchase price is 75 lakhs, which is typical for this location and size. We are using 75% LTV financing, borrowing 56.25 lakhs with a down payment of 18.75 lakhs, right? So let's analyze the annual financial performance. So rental income of 3 lakhs annually and 25,000 basically monthly represents current market rate for this property type and location. Operating expenses of 75,000 include property management, 8% of the rent, maintenance and repair, property insurance, and social, your security, your society charges will be there as part of operating expenses. This gives us a net operating income of 2,25,000. However, our mortgage payment is 5,87,136, approximately 48,928 monthly. And at current interest, this results into negative cash flow of 3,62,136 annually, or approximately 30,178 monthly shortfall. So key insights from this analysis: the gross rental yield is 4%, 3 lakhs divided by 75, which appears reasonable. However, the cash on cash returns is negative due to high leverage and low rental yield relative to mortgage costs. The property builds long-term wealth through appreciation and loan amortization rather than cash flow. The investor must fund the monthly cash deficit of 30,178 from other income sources. So this example illustrates why buy and hold investing in India requires stable external income to support properties during the early years of ownership, because as you can see that this will require some extra cash infusion. So we go to the buy and hold advantages and challenges of this. So strategic assessment of that. So let's see the advantages. So one is that there is a passive income generation with minimal day-to-day involvement. Then we have tax benefits which are given by the government because they want to promote housing. and they can be there. But in case the investment is not being done for the first time, and then there might be less benefits which might be there, because these tax benefits are generally given when we are looking at buying for living actually. And then we have inflation hedge, and this can be a good inflation hedge, so that can be the advantage. Historically, maintaining purchasing power over the longer period, that has been observed in India. And the leveraged appreciation means you benefit from appreciation on the entire property value, not just your invested capital. So this strategy aligns with cultural preference for property ownership in India, making it psychologically comfortable for many investors. So you can take leverage and gain on the overall rise of the property. Then intergenerational wealth transfer opportunities allow families to build lasting wealth that can be passed to future generations. However, key challenges are significant. We have seen that there is low rental yield, and that is very low in comparison to mortgage rates of 8 to 9%, which creates ongoing cash flow challenges. Then we have high entry barriers due to property prices can make it difficult for new investors to begin building portfolios, especially in cities like Mumbai. We have seen that it is very, very costly. Then we have negative cash flow. Requirement means you need substantial external income to support properties. We have seen one example of that. Then we have tenant management responsibilities and vacancy risk. So, which includes, maintaining, basically looking after the property. So that is there. And then illiquidity. So in case of emergency, or when you actually require fund, or you may want to sell your property, that may not be that easy. There is not much liquidity all the time available. So that is there. And then ongoing maintenance and management requirement. So that continues throughout your ownership period. So that is always there, maintenance and management of the property. Then whom it is best suited for. So with stable high income to support negative cash flow. Then long-term wealth builders with 7+ year horizon. So if you have that kind of horizon, then only you should go for it. Those seeking passive investment with minimal active management, then that is there. That can also be the situation. And investors prioritizing capital preservation over higher returns. So capital preservation is there, not higher return expectations, then they can go for this buy hold kind of technique. Then we have fix and flip strategy overview. So this is a short-term value creation through renovation, and basically the approach focuses on short-term value, and the strategic approach emphasizes value add focus through improvements that increases property value more than their cost. So the short investment horizon typically range from 3 to 12 months, requiring different financial planning than buy and hold. Here the management has to be active and it is essential. This isn't a passive investment but requires hand-on involvement throughout the project. Market timing becomes crucial for optimizing both entry and exit points. Capital velocity allows for rapid return generation and reinvestment into new projects. The fix and flip process follows 5 critical steps. First, property identification focuses on finding undervalued assets with the clear renovation potential. This requires strong market knowledge and ability to envision improved properties. Secondly, financial analysis using tools like 70% rule and detailed ROI projections ensures project will be profitable before commitment. Then third is your acquisition, emphasizing negotiation skills and closing speed. In competitive markets, ability to close quickly can make the difference in securing good deals. And then renovation management requires quality control and strict timeline adherence. Delays directly impact the profitability through increased holding cost and opportunity cost. And then we have marketing and sale involves professional presentation and strategic pricing to optimize sale price and minimize time on the market. Then profitability assessment framework. So financial analysis is crucial for fix and flip. 70% rule adopted for Indian markets provide a quick assessment tool. Maximum purchase price equals to ARV times 0.0 minus renovation cost. ARV means after repair value, your expected selling price after renovation. This rule assumes the purchase price plus renovation cost should not exceed 70% of the final sale price, leaving 30% margin for profit, holding cost and unexpected expenses. ROI calculation means project profitability. ROI calculation means basically it's the measurement, that is project profitability is your sale price minus total investment divided by total investment times 100. So your total investment includes purchase price and acquisition cost, renovation and improvement expenses, holding cost like interest, taxes and utilities, and selling cost includes brokerage and marketing. Then annualized returns accounts for project duration. So 1 plus ROI divided by 100 into to the power 12 divided by month per month, 12 divided by month minus 1 into 100. So this allows comparison with other investment and fix and flip projects. So we have target metrics for successful project include minimum ROI of 15 to 20% for project completed within 12 months. Renovation budget should typically not exceed 20 to 25% of purchase price to maintain reasonable risk level, and timeline management is critical. Complete project within 6 to 9 months maximum to minimize holding cost and market risk exposures. These metrics help you quickly evaluate opportunity and avoid project with insufficient profit potential or excessive risk. Then we have fix and flip case study. So let's analyze this case. Our project overview involves a 25-year-old 3 BHK builder floor in established area. Purchase price is 1.8 crores, reflecting the property's dated condition and renovation needs. Renovation budget is 62.7 lakhs for comprehensive update. Target sale price is 2.45 crores based on comparable renovated properties. Project timeline is 6 months from the purchase to sale. Let's examine the detailed cost breakdown. So purchase price of 1.8 lakh plus stamp duty and registration of 12.6 lakhs gives us total acquisition cost of 192.6 lakhs, right? And Renovation cost of 62.7 lakh cover kitchen and bathroom updates, flooring, painting, electrical work and facade improvements. Holding cost of 8 lakhs include loan interest, property taxes, utilities and insurance during the renovation period. Selling cost of 5 lakhs cover brokerage, marketing and legal expenses. This gives us a total of 268.3 lakhs. So unfortunately, our sale price of 245 lakh result in a net loss of 23.3 lakhs. So this demonstrates a crucial point. Not all flip and fix and flip opportunities are profitable at asking price. So key learning from this example, success requires either negotiating significantly lower purchase price, perhaps 1.5 crore instead of 1.8 crores, or finding properties with larger value add potential where innovation can drive higher sale price. So this emphasizes the importance of conservative analysis and the skilled negotiation in fix and flip of investing, right? So market dynamics, we are talking about city specific strategies here. So market dynamics vary significantly across Indian cities, requiring tailored approaches for fix and flip success. So MMR region presents, Mumbai metropolitan region presents unique opportunities and challenges. Focus on older premium properties in established areas like Bandra, Juhu or South Mumbai. Renovation strategies emphasizing the layout, reconfiguration to modern preferences and premium finishing that justify sale price. Expected margin are 10 to 15% ROI with 6 to 9 months timeline. The primary challenge is extremely high acquisition cost that limits profit margin and require precise execution. Bengaluru offers better opportunities for fix and flip investors. Focus on properties near IT corridors with dated interiors that don't appeal to tech professionals. Renovate priorities include smart home features, home office spaces and modern amenities. Margin of 15 to 20%. ROI with 4 to 6 month timeline. The opportunity lies in understanding tech professional preferences for modern efficient living spaces. And then we have Delhi NCR, present opportunities in builder floor in established colonies like Greater Kailash, we have Lajpat Nagar or areas in Gurgaon and Noida. Renovation focus include luxury finishes, security upgrades and modern convenience. Margin of 12 to 18%, ROI with 6 to 12 months timeline, reflects the diverse market condition across NCR. Strategies include basement optimization and facade modernization to enhance curb appeal. And then we also have a Pune. So Pune offers excellent opportunities near educational institutions. Focus on property suitable for student housing optimization with multiple bedroom or conversion potential. And margin will be of around 15 to 25% ROI and 4 to 6 months timelines. And the opportunities, as discussed, educational sector growth. Then we have build wealth. We have buy, rehab, rent, refinance and repeat. So the 5-step process basically creates a systematic approach to portfolio building. Buy involve acquiring undervalued properties with clear renovation potential similar to fix and flip property selection. Then rehab, add value through strategic improvements. But unlike fix and flip, the goal isn't maximum renovation for immediate sale, but optimal improvements for rental appeal and property valuation. Then go for rent, stabilizing the property as an income producing asset. This requires tenant placement, lease execution and establishing rental history that lenders will recognize the refinancing. And then refinance, extract capital through cash out refinancing based on property's improved value. This is where the strategy becomes powerful. You recover much of your initial investment while refinancing the property, and then redeploy the capital, the recovered capital into the next property, allowing portfolio growth with limited initial capital. So, strategic objective include portfolio scaling with limited initial capital by recycling the same money through multiple properties, value creation through forced appreciation, long-term wealth building via rental portfolio provides ongoing income and long-term appreciation. Capital efficiency through systematic recycling allows faster portfolio growth than traditional buy and hold. The risk return profile involves high complexity than other techniques we saw, moderate risk with elements of both strategies, and potential for superior returns through efficient capital utilization. Then is this particular technique is essential for successful understanding it for is essential for successful execution. So we have capital recovery ratio, which measures how much of your initial investment you recover. So amount recovered divided by total initial investment. So higher ratio means more capital available for subsequent investments. Cash on cash return after refinancing shows your ongoing return. So annual net cash flow divided by remaining capital times 100. This often improves dramatically after capital recovery. And then total return analysis considers multiple return scores, cash flow plus equity growth plus capital recovered. This comprehensive view shows this strategy's true potential. And refinancing present unique challenges. LTV limits typically range from 65 to 75%. Interest rate premium of 1 to 2%. And documentation requirements are also extensive, requiring detailed rental history and property valuations. Timeline requirement typically includes 6+ months of stabilization rental history before lenders will consider refinancing. So these factors means this particular technique execution in India require careful planning and conservative assumption and patience with refinancing process, right? And success depends on how low you buy the property, at what discount you are buying it, and completing the valuable renovations to appraisal that appraisers will recognize, right? So then we have a case. So our project, this renovation cost of 27.5 lakhs. It's a 18-year 3 BHK apartment. The rental income is 35,000 monthly, and refinancing value is 98 lakhs. So we can see that through we recover around 13.77 lakhs, giving us capital recovery ratio of 22%, and monthly cash flow is coming negative due to higher mortgage payments after refinancing. Remaining investment comes at 48.72 lakhs after capital recovery. So annualized return over 5 years is approximately 5%, 5% considering cash flow appreciation and capital recovery. Now the key insights here includes the negative cash flow, still requiring external income support similar to traditional buy and hold. However, capital recycling enables portfolio expansion faster than would be possible with buy and hold alone. Long-term wealth building occurs through equity accumulation across multiple properties. Market timing remains critical for successful refinancing at favorable terms. So that is there. Then strategy comparison. So time horizon varies a lot. Buy and hold requires long-term commitment. Fix and flip operate short-term, 3 to 12 months. And the third one actually requires medium to long-term with renovation phases followed by long-term holding. Then we have capital requirement that affect the accessibility, capital requirement, the effects which affects the accessibility. Buy and hold needs high initial capital, then with slow recycling. Fix and flip requires moderate capital with rapid recycling through project completion, and the third one needs more moderate initial capital with partial recycling through refinancing. Active involvement, buy and hold low in fix and flip, and the fourth one, it is high, and initially in the third one, that is BR4, it is moderate, and then after that, it's high initially and then moderate afterwards. Then risk in buy and hold, it is lower, but market exposure is there. Fix and flip is basically risk is higher, but it is not based on the market but project specific. And the third one, the risk is moderate, and it is a combined element of market and project. Cash flow, buy and hold often negative initially, but in fix and flip none, because we have to one-time profit we have to get, and often this one is negative post refinancing. Skill requirement, property selection is there, very important, and the management of the property, because the overall management has to be there. And then renovation is very tricky. A lot of skill will be required, and along with that market timing must be there, so a lot of skill. Then this will be also requiring a lot of skill. Then tax implication, here we have long-term capital gains, so lower tax for this. This will have short-term capital, and the third one depends on what we generally do, but it will be if the project is of less than 1 year, then we have a short term, otherwise it will be long term here. And the scalability will be slower due to capital needs, and then because the capital is stuck with a particular investment. Here the scalability is possible because is possible only after you sell the property and move to the next one, because while you are invested, you are completely involved in it. Here it is faster through capital recycling, because you go for the refinancing, and that can help you in scalability. Then numerical comparison. So we can see that our property scenario involves purchase price of 70 lakhs, renovation cost of 15 lakhs, post renovation the value is 95 lakh, monthly rental potential is 28,000. 5 years performance comparison. So buy and hold invested 32.5 lakh, 5-year return 28.71 lakhs, fix and flip 43.85 lakh because you improved it, renovated it. 5-year return is 2.15 lakh, 10.1%. You sold it in 6 months. So that is there. And BRR, which is 21.1 lakhs, is to 20.98 because after capital was refinanced. So that is the reason it is like showing like that. But the analyzed return was greater, was 14.8%. So buy and hold requires highest initial capital but generates steady returns. Fix and flip offers quick return but thin margin in this example. The BR4 provides highest annualized returns with lowest remaining capital. So that is this particular example, but it may not be generalized to every time. Then market specific considerations. So regional strategy will be there. Tier 1 cities, Mumbai, Delhi, Bangalore, Chennai, Hyderabad, Pune. Advantage, strong rental demand and liquidity. There is a professional property management services available, better financing options available, and institutional lenders are also present here. And higher appreciation potential is also there because there is a continuous demand in these cities. Challenges are also there, that high entry cost and competition, very costly real estate, lot of competition, lower rental yields relative to the property prices. Property prices are fetching very high cost, and in comparison to that, the rental yield is very low. Stringent regulations are there and compliance requirements are there by the city authorities, and that is there as a challenge. Then in comparison to that, tier 2 cities like Ahmedabad, Jaipur, Lucknow, Indore, Coimbatore, advantage is lower entry cost and better affordability, higher rental yields in select micro markets, and not everywhere but in specific markets, and then less competition from institutional investors because of the kind of cities we are talking about, and potential for higher ROI percentages. And these institutional investors, basically you compete with them in commercial real estate, and so return on this returns also are higher. So then challenges, limited liquidity and longer selling cycles. The liquidity market, in the market there is not lot of buying and selling taking place. Fewer financial options are there, and lender choices are also not high as the tier 1, and there is lower absolute rental amount. So rental amount though may be in terms of this might be higher, but percentage terms it might be higher, but in absolute terms it is not very high. And infrastructure and amenity limitations are also there, that the accessibility and other issues are there with the real estate. Then coming to risk management framework, so mitigation, investment risk, property level risk, there is a title verification and legal due diligence we have to do. Structural assessment for older properties have to be done because they might be in bad condition. Then location analysis and future development plans, where the location of the real estate is, what are the the infrastructure development taking place there. So that is your property level risk we are talking about. Tenant quality is also where it matters a lot because the kind of tenant we are talking about. So that has to be screened. Financial risk also has to be looked into. That interest rate fluctuations, market timing, cost overruns can be there in renovation projects, and vacancy periods can also impact the cash flows. So that also we have to bear in mind, especially in the other two techniques which we studied apart from buy and hold. And then regulatory risk of RERA compliance for new projects. So that is there. Tax law changes affecting the investment returns. So that also has to be looked into, that what is the short-term capital gain, long-term capital gain. Recently, they have been increased. So if somebody had used earlier, so they would have come to wrong decision, maybe about buy and hold, or fix and flip. So these type of things can impact. Municipal regulations. Maybe you have thought of opening, a hostel or something, and it is not allowed because parking is no more available. So these type of regulations can also impact. Rent control laws also may regulate the amount of rent you can charge from your tenant. And then portfolio level risk will be your geographical diversification. That is generally advisable, but mostly in real estate it is very difficult to do that. And then property type diversification, whether you are going for residential, commercial building, you can combine also, but generally that is restricted to very high net worth individuals. And liquidity management through staggered investment, so that can also be adopted, but that is again something which is very tedious. Then we have tax implications. So we have seen income tax can impact capital gains, how much time period you are taking about. So long term it can vary, like the rules and regulations are continuously changing. So that is there. Then taxed as per income tax slabs. So then hybrid approaches, we can have rental income taxed annually, capital gain treatment depends on the holding period we are talking about. So that is there. So but overall the idea is that whenever you are looking at these approaches, you should be updated about the current tax regime which is prevailing at that time and then take the decision. Then current market trends, prop tech platform, virtual reality tools, digital payment systems and smart home features are quickly coming up and changing the overall scenario. Regulatory evolution, DERA has come, REIT growth is there, GST rationalization is there now, and then model tenancy acts are also coming. So these are the trends which are there. There are the gradual movements of improvements which we can observe, and they will definitely impact whether it is your buy and hold or whether it is your fix and flip. So definitely they will be impacted by technology and regulations. And demographic shifts, we have discussed that how millennial preferences for IT employees can can generate business options for what kind of strategy you are looking for, whether you are going for a fix and flip or whether you are going for BR4. So these kind of things can also be seen. And infrastructure development, metro connectivity, how good it is, you can look that also. Smart city initiative, that is, all these things are also happening and gradually they are picking up. So more and more of such opportunities will be impacting our strategies. So overall, if we want to build our strategy, self-assessment, define investment objectives, assess available capital, evaluate time commitment, how much time you can give, identify the skill, whether you have the skills, you can renovate and do all that. So second and third may be applicable, but otherwise if you can just invest capital, the first one is only option. Then market research, analyze the micro market, because each market is different, like each property is different. So market research has to be done. Comparable properties, look at that and gauge the trend. Assess the rental demand which is there, and then evaluate the infrastructure development, what is plans by government in that area, because that may impact by the time your project is completed or by the time you have given it for rent. So all that can be impactful. Build networks of professionals. You should know more and more people so that you know what is happening currently in real estate in that area. And strategy implementation, start with smaller investments to gain experience. Document and analyze each investment decision. Build systematic processes and consider professional management. So that is your strategically you should think about this. And portfolio scaling, diversify across strategies, optimize financial structures, implement technology solutions, because these are your processes which can help you in scaling, and plan the exit strategies for long-term objectives. That is when you are coming into a particular project and when you are selling it. Look at that way. So key takeaways, it's no one size fit all strategy. Choices depends on the individual circumstances. If you have seen whether you are technical enough, you can go for the second, third technique, but not if you are not technical person, you don't know how to do all that. You have to understand the Indian market realities, the lower rental yield when you take decisions. Cash flow challenges will be there, so you need some other source of income initially. Long-term perspective you should have, because these are not small time operations, especially your buy and hold. Then financial considerations, leverage amplifies returns, but it can become risky in the down-term situations. For example, there have been cases where in upcoming universities, people ventured out and opened their hostels, or they were about to open their hostels looking at the rising demands, But due to COVID, there was this sudden drop in occupancy of hostels for 2-3 years, and there was a lot of pressure. So even though they were able to recoup their money later on, but during those dry periods, they had to give their EMIs and everything. So the leverage was working against them at that time. So transaction cost in India are also very significant. Lot of stamp duty and everything. So that has to be done. Then success will depend on location selection, professional network, continuous learning. So that is there, and future outlook, technology adoption will continue reshaping, and all these will keep affecting the market. So final thought, this is your journey. Significant wealth building potential, but require careful strategy selection through market research and disciplined execution. So more improved transparency, growing institutional participation, and technological advancement we should look. Thank you so much.